Hello, everyone. Welcome to the show. With me today are two of my colleagues from Gunnercooke, Graham Reid and Owen Watkins. Graham is a banking and finance lawyer and advises on creation of structures to raise money from parties, including accessing finance from retail customers. Owen has been with the FCA in total for about 15 years and then left in 2005, his final stint. And has been in private practice since, and he's advised on pretty much a lot of financial services regulation and promote financial promotion particularly, and has obviously an in-depth knowledge of the FCA handbook. So welcome, Graham and Owen.
Thank you.
Thank you.
Let me get stuck in. We had a lot of great discussions before we hit the record button. I was very conscious to try and get the recording underway so that we can capture some of that great discussion. Let's start with the basics. So as I mentioned, SME property developers is my main client base. Can property developers simply go out and raise either debt or equity from private individuals, or for that matter, businesses, or do they need to be, is it a regulated activity? Do they need to be FCA authorized?
I think a very simple answer to that is that you can't just go out there and say to anybody, come and invest in my business or give me debt. The reason for that is that the regulatory authorities don't want to see people who, in their view, don't have the money to make those investments, making those investments. So if we want to start from the most simple proposition, if you want to raise money, either by debt or by equity, you have to follow the specific rules which are there in order to protect those investors.
I think the only thing I'll add to that is that the regulators have pretty much from the beginning of what you might call the rise of crowdfunding, have taken the view that crowdfunding is high risk. And as a result, investors need to be protected from the risks of investing in a crowdfunding-backed product, particularly in the current environment where we have extremely low inflation, extremely low interest rates. And so people would be tempted by headline rates of 8, 9, 10%, for instance, and as a result would put in more of their money than would be advisable. And I think the regulators are very conscious that not to put too fine a point on it, a fool in his money are soon parted, and the greedy in their money are soon parted as well. So they want to put a regime in place that makes it as difficult as possible, if I can put it like that, for people to be able to raise money from the general public via this route.
So that's interesting, because one of the flip side, the counter argument to that is with a crowdfunding, especially on a crowdfunding platform. And I suppose you could do it individually as well. If you were in a position where multiple developers, you're an investor or a lender, multiple developers approached you, and you were to spread your exposure over a series of projects. And reduce your exposure to a few grand, for example, a few £1,000s. That might be one way to actually limit your risk. And the crowdfunding platforms offer a great way to do this, because they're bringing in all the property developers and projects for you to invest or lend into, and so inherently there is some de-risking them.
I think the regulators would say that yes, you can spread your risk, but you're spreading your risk among a group of risky propositions. So you're not de-risking it in any meaningful sense. To use a horse racing analogy, you're just putting bets on a whole bunch of back markers and not particularly favorably backed horses in the hope that one of them will come home. But since none of them are the favorite, the odds on any of them coming home are very slim. And I think that the regulator would say, in effect, you're just putting your money down 4 or 5 drains rather than it just all down one. Now, clearly, there is the possibility that you can de-risk in the way you've just described, but I wonder whether, from a regulatory perspective, you'd say that de-risking is more theoretical than actual.
I'd just add to what Owen is saying in terms of going to one of these, crowdfunding platforms. It does have the attraction that a developer doesn't have to get involved with the nuts and bolts of how he is going to make that offer. He should be guided by the platform who will tell him what he has to do, the paperwork, etc., etc. However, he is then dependent on the ability of that platform to get his message out. So in very simple terms, if that's a website and nobody hits on the website, he's not going to sell any product. If that website is well known, there may be more hits on the website and more money may come in. But just coming back to your original point, which is spreading the risk, if he is one of multiple developers, then his development is in direct competition with other potential investors. So, although you pay the crowdfunding website to help you deal with all your regulation, the payoff is that the distribution may not be as much as you could expect if you went to the market solely on your own.
Wait, Graham, what do you mean by going to the market, solely on your own? And let me give you some context here, because there are a lot of property networking groups up and down the country, which will regularly ask property developers to come and speak. And a big part of their talk will have a salesy element to it, for want of a better term. But they're positioning themselves in terms of experience and projects that they're running, and clearly with the view to inviting potential investors or lenders to fund existing or future projects. So is that what you're talking about in terms of going to market, or something completely different?
Without going into the niceties of the legalities of standing in front of someone and saying, this is a great opportunity, come and invest in it. In very simple terms, that's distribution. You are giving people the opportunity to invest directly into your product. And what we mean by distribution is the more people that you can offer your product to, the more likely you are to get higher numbers investing. So, if you have, for example, had a investment channel that went to 100,000 people, then the chances are you would probably raise more money through that than you would if you were on a website that may well be hit by 1 million people, but had 200, 300 different products, but all of a similar nature.
I'm interested to know, that example that I gave, for example, a property developer who's standing in the front of a property networking room and talking through the projects that they've done. At what point does is there a line, a very clear line, let's put it that way, at which point FCA regulation does kick in, when it becomes financial promotion and therefore a regulated activity? I
think that, unfortunately, from the perspective of those who will be viewing this video, there is a line, but it is easy to, at the extremes, to see which falls one side of the line and which falls the other side of the line. But at the margin, it is not at all easy. And I think that although this may sound as if we're, as it were, pushing our own book here, you do need to take specialist advice in relation to that if you are thinking of having a presentation with people who you would like to ultimately invest in what you have to offer. So I think I'll leave it at that sort of very vague stage, but there is definitely a difficult line to be drawn, and you do need to be the right side of the line, and you do need to take specialist advice in relation to that.
I think Owen is absolutely right. I know that we're almost taking the fifth, as one would say, on this, but it's incredibly complicated, and it's something you must do correctly, because in this very litigious environment, if I was to stand, or you were to stand in front of them and say, come and invest in this is a great thing, and they lose all or a substantial amount of their money, they will be wanting to try and get that money back. And if you haven't ticked all the boxes in respect of raising that money in the first place, that gives them a very easy opportunity to get their money back.
By instigating a FCA investigation and a financial compensation claim?
If you're not authorised, then you won't be able to, the Financial Services Compensation Scheme won't feature, because the FSCS only applies where a regulated person is carrying on a regulated activity that's covered by the compensation scheme. So it won't be a question of that. But you're absolutely right. There will, in that case, be the issue of whether you were carrying on a activity which would be regulated, but where you are not regulated. So you're committing a criminal offence, potentially punishable by a unlimited fine and 2 years in prison for any person who's involved. So it's a serious penalty, and you just don't want to be involved in that. I mean, it is a difficult area, because ultimately you're going to potentially take a view on whether particular information provided to people is just pure information, or whether it's actually marketing, financial promotion, as the legislation calls it. And that's often not a very easy area to distinguish. I mean, from a legal perspective, and sitting where I am, I'd always err on the side of caution, simply because the penalties for getting it wrong are so draconian.
Given the risk, and unless you're getting the presentation that you're going to give to a room of property individuals vetted by someone like one of you beforehand, it sounds like it's going to be better to fall under an umbrella type regulatory cover, perhaps like through a crowdfunding platform. Would that be fair to say? So rather than risk the criminal penalties and breach of the FCA rules, get under the cover of a crowdfunding platform and raise funds that way. Would that be fair to say? Or
yes, if you are raising money under the cover of a crowdfunding platform, which will have the marketing material vetted by an FCA authorised person, and so the promotion that you are making will be a legitimate promotion, then clearly that aspect is covered off. That said, it is possible for people who are not authorised and who do not involve a authorised person to approve any marketing material to make presentations. What they do need to do, however, is to ensure that the people who legitimately attend those presentations fall within an exemption to the general rule that a financial promotion must be made, or the content of the financial promotion must be approved by an FCA authorised person. And two of the most commonly used exemptions are those for high net worth individuals and or sophisticated investors. Now, those require a few hoops to be gone through, not least that you need to be fairly sure that the people who you're making the promotion to do indeed fall into that category. How do you establish that? Well, the most obvious way to establish that is to get them to tell you that they've actually executed the necessary certificate that says, yes, I am a high net worth individual. Yes, I am a self-certified sophisticated investor. The things to watch with that, again, so I'm sorry, this sounds like a litany of difficulty, but in effect, that's what it is that the certification has to be in a set format. And if you look at the exemption literally, if you make any mistake in the form of wording that you use, the certificate becomes invalid, and therefore the promotion you make to a person, even though this person you might think has executed a proper certificate, if the certificate isn't proper, then the promotion's illegal. So there are things like that to watch. As you say, if you do it under the cover of a crowdfunding website, then those issues are for the website. So that becomes a problem that's theirs, not yours. But it remains possible for you to make promotions without the cover of an FCA authorised person. It's just that you need to take a bit more care about the format that you adopt.
I'd just add to that, I think it's definitely worth, if you are dealing with a crowdfunding platform, to work out exactly what they are allowing you to do in terms of, let's say, marketing your promotion and what they are going to do. I think it will do a lot of good if you can understand just exactly what you're able to do, as that will give you much more flexibility as to, you know, whether you can market to people in a room or not.
There's 2 points I want to touch on that, Graham and Owen. Let me deal with the first one, which is the point about, Owen, that you made about the self-certification that needs to follow a set format. So going back to that example that I gave of a property developer who's standing in the front of a property networking room, really what needs to happen before they even give that presentation, assuming that the presentation itself is a form of financial promotion, is that self-certification questionnaire needs to have been done before the attendees enter into the room and sit down to listen to the talk. And that questionnaire needs to follow the format that the FCA is accepting. And the completed questionnaire, either in hard copy form or electronic form, needs to be then kept by both the organizer of the meeting, but also the developers talking at the front of the room, presumably for 6 years, the usual kind of rule. Is that right?
Yes, I mean, yeah. It's always sensible to keep copies of these things, just in case any dispute arises as to whether someone said, well, I'd never signed that, and you made a presentation to me and you knew I wasn't a self-certified sophisticated investor or a high net worth individual. Yes, I think that's right. If you think about there certainly were certain websites that were available where you were there was a gate, as it were, at the front, and it basically said, only if you are a person who falls into one of the following categories are you able to have a look at what's behind the gate. And one of those categories was high net worth individual. The other was self-certified sophisticated investor. And so you warranted that you were in one of these categories before you were allowed through. Now, at that stage, you weren't providing anyone with the necessary documentation. You can argue as to whether that was perhaps taking a bit of a risk with the regulations, and it's obviously better if you can see a document that's been executed by the individual concerned. But certainly, based on past history, it's likely that at that stage, just a mere assertion that you are high net worth or self-certified sophisticated would potentially be good enough. What you would need to do in that case, I think, is that at the time when people were going to invest, you would need, before you took their money, to have a written evidence of their qualification to fall within one or other of the exempt categories.
So it sounds like, you could, in some instances, still raise funds directly, so long as you've gone through some vetting process. But the received wisdom, or the best course of conduct approach really is to consult a financial regulatory lawyer and ensure that you're on the right track before actually, taking that money off that individual. Graham, I know that you have experience with mini bonds for your clients, and before we came on or hit record, when you and I were speaking about some of the issues that there's been mini bond failure, so to speak, within the property sector, as a result of which the FCA has actually shut down that avenue. Do you guys have some thoughts on that? Is it still a good way to go? Is it a no-go area now? Any thoughts on that?
I wouldn't say that. Again, the concept of a mini bond it's not a legal term, so to speak. It's something which has grown over the years in order to try and allow further people to invest in products. And what we mean by that is, as we said at the start, about the regulatory authorities seeking to make investment as difficult as possible, in the sense of making sure that investors are fully aware of what they are doing. Hence, as we've discussed, people signing forms, etc., etc. Mini bonds were developed as a means by which financial products could be invested in by people who were not as rich as the financial regulator probably wanted to see in those products. In a roundabout way, mini bonds came about because they allowed easy access for certain retail investors. These took off, and a number of companies used them, and through sophisticated marketing, they were able to access retail parties who then invested in them. This came about because of the way the products were structured. It meant that they didn't have to go through all the regulatory hoops, and they, as I say, if marketed correctly, lots of people came into them. As again we've said, this investment tends to be high risk because you can't get the money elsewhere. So, you're looking at lots of people who maybe shouldn't have invested in these products, who are now facing high risk situations. And I think we've seen recently what has happened when these high risk situations have blown up. So you then see lots of scandals, bad investments, etc., where lots of people have lost money. And the mini bonds, therefore, have got what would say is a bad reputation on that basis. That's not to say that you can't have a company. So a developer could issue bonds because they are a security. If you've got shares and you've issued shares, a bond is a similar type of security, but in this case works very much like a loan. It's a debt which you owe to somebody. You can still issue these, but you can only issue them to very specific people. And again, that can be summarized as being non-retail investors. So as we've touched on before, people like high net worth and self-certified investors. That's on the basis that those parties understand the risks that these bonds may have, i.e. investing in a developer in a situation which could be categorized as high risk. Anyone want to add any more to that?
I think that puts it well. I mean, I think the only thing I'd reiterate is the point I think I made earlier, which is that the regulator regards mini bonds now as being unsuitable for all but a small handful of retail investors. And I think the relatively recent changes to the FCA handbook to cover the marketing of those products shows that.
So, we've touched upon the potential for using a crowdfunding platform that's already regulated as sort of regulatory cover for a property developer who's raising funds. Some of these crowdfunding platforms themselves are appointed representatives of a regulated entity. Now, help me understand this first, and my audience a little bit. What's the difference between, or the primary difference? I know there's lots of differences, but the primary difference between being directly authorized by the FCA and an appointed representative of a directly authorized entity.
I think probably, given my background, this is for me, although Graham may want to chip in at the end. I mean, the main difference between being a directly authorized FCA entity and an appointed representative of a authorized FCA entity is that your relationship as a appointed representative is not with the FCA in the first instance. It's with your principal, the directly authorized firm. If you are regulated by the FCA, you have a relationship, obviously, with the FCA. You have to go through a much more stringent process of approval than you would need to go through for being an appointed representative of an FCA authorized person. Although the way in which it works, the FCA approved person being responsible for the actions of the appointed representative means that if a person who is taking on appointed representatives is taking their position at all seriously, they will want to have a very close handle on what it is that you are doing because they are responsible for it. So I think in most appointed representative arrangements that I'm aware of, in effect, for regulatory purposes, the appointed representative is really like a department of the authorized firm, because the authorized firm is equally responsible for the actions of its appointed representative as it would be of its internal department, its marketing department, for instance. And as a result, you will find, if you are entering into an appointed representative arrangement, that not only will you have to submit to very close oversight by your principal firm, but also the principal will probably charge you a reasonably hefty monthly fee for that privilege, simply because the risk to the principal is just as great as it would be for any of its constituent parts.
I totally agree with that, yeah.
For a property developer, one option is to ensure that the audience that you're speaking to is heavily qualified before you actually speak to them and open up, for example, a financial promotion. a slightly better way is going to be going through a crowdfunding platform, and if I can use the term, piggybacking on their FCA authorization, either directly or as an appointed representative. Could it be also feasible for some property developers, obviously of a certain scale and what have you, to consider going through the FCA regulatory process themselves, either as an appointed representative, or I think, maybe not directly regulated by the FCA because they need to be of a certain size, and I struggle to see how a SME property developer might want to go down the full FCA authorization route. But should they consider perhaps becoming an authorized, an appointed representative?
Just picking up your point about size, yes, I'm sure you're right that the sort of people that you're thinking about, FCA authorization doesn't make a lot of sense, both because it's expensive, it's time consuming to make the application. You're probably looking at a period of 3 to 6 months before you put the application in to make sure the application's in a proper format for the FCA to look at it, and then the FCA will probably take 3 months or so to finally decide, and maybe more. So you're probably looking at something in the region of 6 to 9 months minimum before you were authorized. Now, it's always possible, and this is what a lot of people do. You've probably heard, and some of the people watching this will have heard of the wonderful phrase, regulatory incubators, regulatory umbrellas, where there are certain firms that basically have a whole host of appointed representatives under them. And the idea is, I think, that those appointed representatives take the temperature of whether they've got a business proposition that is a feasible one long term, and then whether they would want to move on from being an appointed representative, which is, as I said earlier, a lot more straightforward as a means of going forward, whether they'd want to go on from that to make a FCA application in their own right. And one of the things that is worth pointing out, although it's probably fairly obvious, which is that if you do decide that you want to go down the full FCA authorization route and you make an application, you can't carry out the business that you want to carry out until the FCA has decided whether you're fit and proper to be regulated or not. Whereas if you become an appointed rep and you then decide to make your application to the FCA for full authorization, you can carry on the business as an appointed representative. So that's a big plus. There's no hiatus between stopping being an appointed representative and being fully authorized. You can wait and see whether you're going to be fully authorized or not, and keep going. So that's a big plus. You're absolutely right to come back to the point you made. An appointed representative route for operating within the regulated space is definitely the cost-effective way to go for the firms that will be watching this video.
I would only say as well that being regulated, whether that's your own regulation or whether that's being an authorized representative, is not necessarily the way forward. And again, picking up on what we said earlier, this area is so complicated that you really need to speak to somebody who understands that area in order that your particular needs can be best addressed.
Before I hit the sort of record button, when you and I were speaking about the merger that's in the pipeline at the moment between Crowdcube and Cedars, we're speaking in February 2021, and the mergers being considered by the CMA. And something that both of them have said is that if the CMA have said that they're not sure that they should allow this, and both of them, Crowd and Cedars, have said is that, look, if you don't allow us to go through, then don't allow the merger to go through, then we can't really see us continuing because it's a precarious situation. Do both of you have any comments or insights into that?
Yeah, it's interesting that they're running the argument that we need to merge and you need to approve our merger because we need to have a sustainable scale of operations, which if we're not allowed to merge and we're just left competing against each other as we were before, there isn't really enough business to go round, and that's an interesting argument. I don't know whether it's an argument that they perhaps 100% believe in, or whether they're running the argument in the hope that this brings some pressure on the CMA to wave the merger through. But if you take it at face value, I think it does show that the crowdfunding market, as seen on the platforms, is quite a precarious market, and perhaps more precarious than many of us had realised.
I completely agree with Owen on that. I think that the crowdfunding websites have probably been able to promote themselves as being better at the job than they actually are.
That comments that I think both of them said with regard to the CMA process is certainly very interesting, which I thought also highlighted that it appears there's a lot of for want of a better term, price competition amongst the platforms, and therefore economies of scale through a merger would ensure a more sustainable business going forward. And I think actually the function of crowdfunding for multiple sectors is quite a useful one, and it should try to be the CMA should allow it to try and maintain itself. But the difference, I think, primarily between the the crowd cubes and the seizures as compared to debt and equity crowdfunding platforms for property is that there isn't usually a valuable security, underlying asset there. With property crowdfunding, there's usually a property asset, and you will usually get, if it's a debt crowdfunding raise, there's a first charge security there. Even if it's equity, you will still have maybe 20 or 25% of the value of the asset that's sitting within the SPV that is raising the funds. It's very different with startup, which is usually the entity that's raising funds through the likes of Crowdcube and Cedar, because let's face it, they're probably looking for angel funding rather than more senior, VC round, because by that point there are a lot more established businesses, which is when they'll start to attract the attention of VC funds. So I think it might perhaps be a slightly different argument amongst the property crowdfunding platforms. But having said that, there is a perception amongst SME property developers that crowdfunding platforms are expensive. And having spoken to a founder and CEO of the Blend Network in a previous video, I found that the rates are actually very similar to what a lot of developers are paying to existing bridge lenders now anyway. So it appears that the costs are not particularly high, and there's a lot of competition even within the property crowdfunding platforms. There's quite a few of them around. And Owen, based on what you said, there's a high monthly cost that they need to pay to their umbrella regulator, as a appointed representative. So it almost feels as if there might be some structural issues that's building up within this sector as a platform going forward. Would you agree with that?
Yes, I mean it's interesting the point you make about the property crowdfunding platforms, that there is actually a finite set of assets that backs the lending proposition, and therefore it's although these weren't the words you used, and I hesitate to put words into your mouth, it's therefore a less risky proposition than just putting money into a startup or virtual startup, because, as we know, so many startups fail within the first 3 years anyway. The only point I'd make on that, and although I don't think it entirely undermines the point that you make, is that it's the security it looks great when you don't have to use it or enforce it. It's when you have to enforce the security that you realize the strength or otherwise of the security that you hold. So I think that you always need to factor that in when you're looking at whether your investment is actually backed by something that, when the chips are down, can come to your rescue and give you your money back or your return. Because I think in many cases, in a sort of fire sale circumstance, that isn't going to be the case. And as a result, the proposition is possibly only marginally less risky than investing in a startup on a crowdfunding equity crowdfunding platform.
And I think very telling with that is the fact that this type of finance, lending or investing, is not covered by the financial compensation scheme. And most crowdfunding platforms will say your capital is at risk. I act for some high net worth individuals who do private lending as well. And sometimes I've seen over the years that there's a de minimis, there's no point going below a certain loan book, because if it goes pear-shaped, and then the cost of enforcement is just going to outweigh the whatever profit you could have made on that loan. It just doesn't make sense to do that. But I see a lot of small or smaller investors and lenders who are willing to make that sort of lending or investment, and I fear for them, because they don't have the infrastructure and the experience and sometimes the resilience to go through the enforcement process, which can be quite taxing from a cost perspective and also from an emotional perspective in business. Whereas relying on the crowd, leveraging the crowd and the platform, especially if there are appointed representatives who then needs to step in to ensure, even if the platform fails, the umbrella entity is the one that's ensuring that security is being enforced, and all the rest of it might actually be a better way of going about it. Any thoughts on that?
Yeah, I think it's at the risk of stating the obvious, enforcement through a crowdfunding scenario is going to be dependent upon the documentation which was put in place when the investment was made, together with the parties that are involved in administrating that investment. So the fact that a party is invested through a crowdfunding scheme is absolutely no guarantee that they're going to be in a stronger position in order to enforce their security. One could even argue that because they went in and they only had a little amount of money involved, that they were in a poorer position, because the developer could say, well, actually, they're all lots of small people. If they want to come after me, they can come after me, but it's not going to be worth it for them. So again, one of the lessons here is that, you have to look at the structure that the investment is being made. It's not just a case of, put my money in and I'll get my money back. It's a case of looking at it and understanding, the risks of that investment. And again, coming back to where we started, one of the reasons why the regulatory authorities aren't happy to see people who don't understand and don't have the money get involved in these investments.
I think that the point about enforcing and in effect a decision for the person who's got the power to enforce as to whether they enforce or whether it's just not worth it financially. You see, particularly in relation to the other sort of crowdfunding that we haven't mentioned, but I'll touch on here, which is the so-called loan-based crowdfunding, peer-to-peer lending. And you see that in many cases where borrowers can't meet the interest payments, and the operator of the platform then has a decision to take as to whether to enforce the security against the borrower, or just let the loss ride because it's just not cost effective to enforce. And of course, that may be from the perspective of the platform operator a sensible decision, but of course from an investor's perspective it's a bad decision, because that means that part of your investment has gone and you're not going to be getting it back. And it's, I think, important, and I think that we touched on the view that the regulator takes of crowdfunding platforms generally, but I think the regulator would regard it as important that it is made crystal clear to the person who is making the investment that this is the risk, and it shouldn't be buried away in a lot of fine print notes at the bottom of clause whatever, where most investors just aren't going to be able to find it easily. So I think the important point to make is that if this is going to be, as it inevitably must be, a commercial point as to whether security is going to be enforced or not, that point needs to be made crystal clear to investors, because that ultimately is going to be what determines whether they're going to get their money back or not.
That's an interesting point, because I agree. You know, the decision to enforce the security does remain with the crowdfunding platform as the appointed agent of the multiple lenders or investors. And so far, there isn't a great degree of clarity on the crowdfunding platforms in the projects that I've reviewed as to when the crowdfunding platform will actually decide to start enforcing that security or take measures when a debt or equity raise is not going to plan. So that's quite an important point. Let me finish with this. So from both of your perspectives, as a for a borrower or an investor looking to put money into a project or a startup or a venture through a crowdfunding platform, what are some of the things that they ought to be looking at as, you know, for the crowdfunding platform itself? What makes a good crowdfunding platform, if I can put it that way?
I mean, from my perspective, I think the important thing for the platform is to ensure that it makes the risks involved in the investment crystal clear, and it does not take more money from an individual investor than that individual investor can afford to lose. In other words, it requires the investor to declare to the platform that he or she is basically not putting their life savings into what the regulator would regard as a inherently very risky product. If they can do that, I think that they will cover themselves off against the most obvious complaints that any investor could have, which is, you didn't tell me about this risk, and you didn't tell me that my life savings would be at risk if I were to invest in this investment proposition. And if you can get rid of both those complaints, then I think any other complaint that you would have would be marginal and shouldn't affect the health of the platform.
I think that's got to be the key point. I would probably turn it around as well, that if you are a developer and you are going to one of these crowdfunding websites, I think you need to ask the pertinent questions, which is, are my risks of raising money through this platform adequately covered? And by that, I mean, if, my project doesn't go the way I hope it's going to go, I am not going to be left in the lurch having to deal with investors who told me, who say to me, well, actually, you didn't deliver me a 10% return or whatever. I want my 10% and I want my return. And I think that's the key point, that the developer is paying the site in order to market the investment, and they want to make sure that it is correctly done.
Fantastic. Just to round off, is there anything else that you would like to sort of share at this point based on what we've said so far?
I think just to round off, just reiterate that, if you are seeking to raise money through debt or equity from members of the public, you really need to take legal advice. But you wouldn't expect anything else from us.
No, great. Graham, Owen, that's been brilliant. Thank you very much for coming on and sharing your thoughts and your experience. I think it's certainly a very complex area. And I agree, before you venture into this, it's always good to get some guidance. And most lawyers are quite friendly, and they'll usually have an initial chat with you just to ensure that you're not going down the wrong path. Certainly, we're here at Gunnercooke are very friendly indeed. So we'll be more than happy to help. And I'll link through to your respective LinkedIn profiles and also the web pages on Gunnercooke for all those who are interested. So thank you very much, Graham and Owen.
Thank you.